Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the On24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. You can resize these widgets for a larger or smaller view. You may also follow along with a PDF version of the slides that can be found in the Related Content widget. In the Related Content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Using the Reaction button, you can react to content throughout the webinar. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the Speaker Bio section, you can find out more about our presenters, including their contact information. If you need technical assistance, please use the Help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the Evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic.
Well, good afternoon, everybody. And for some, it may still be morning, so good morning to you. And welcome to Mind the Gap, Succession Planning for Nonprofits. Thank you so much for joining us today. My name is Patty Withington, Director of our Prime Market, and I live in the Cambridge, Maryland area on the Eastern Shore.
Thank you, Patty, and thank you to the audience for bearing with us, watching that intro video 1.5 times instead of just one time. My name is Tracy Antonick, and I'm an associate in our elite market, and I'm in Greenville, South Carolina, just at the foothills of the mountains.
So a little bit about your part-time controller. YPTC is a professional services firm that has specialized in nonprofit financial management for over 3 decades. With the goal of helping our clients sleep at night, our services include day-to-day support as fractional CFOs, interim controllers, and part-time bookkeepers. We support financial reporting, forecasting, budgeting, data visualization, and best practices, just to name a few. We have over 800 staff members helping over 2,000 clients in 13 regional offices and remotely throughout the United States.
Just a few quick reminders from the video that played at the start of this session. For this webinar, we will be using automatic attendance checks. You can track your progress within the Earn CPE widget icon on your screen. And we want to hear your questions. Use the Q&A widget to submit any questions you have, and we will do our best to address them throughout the session. We will also stay on after the webinar for up to 15 minutes at the top of the hour to address any additional questions. Please note that the additional Q&A time at the top of the hour will not count towards CPE.
So many organizations rely heavily on one long-term accountant or finance team member. And when that person retires or leaves, it can create real disruption, especially in lean environments. Today, we are going to look at how your financial work is currently structured, where responsibilities and knowledge really sit, and where there may be vulnerabilities you haven't had to think about yet. Again, this can apply to your company or to your clients' companies or organizations. We'll compare different financial management models, talk through realistic staffing or outsourcing options, and look at how technology can help maintain continuity and internal controls.
And here's how we'll spend our time today. We're going to build from why this matters to what you can actually do about it. First, we'll talk about why succession planning matters right now, what the current talent landscape looks like, the real consequences when we see when transitions aren't planned, and why this is becoming more urgent for many organizations. Then we'll shift into understanding your current structure, mapping who's responsible for what, where vulnerabilities tend to show up, and the internal controls that really matter during a transition. From there, we'll get very practical with transition planning, both the people side and the process side, including frameworks, timelines, and action steps you can start immediately. We'll wrap up with a real-world nonprofit case study to apply everything we've discussed. The goal by the end is that you walk away with a clear picture of your risks and a realistic starting point for your own succession plan.
So before we get into the why, let's take a minute to clarify what succession planning really means. When we say succession planning, we're not talking about a one-time document or a replacement chart. We're referring to an ongoing way of preparing for transitions, documenting what really matters, clarifying responsibilities, and putting systems in place so that work continues. And even if you don't have an internal successor lined up, succession planning is still critical. It's really about continuity, not just who comes next. For example, here at YPTC, we have what we call win the lottery rule, with the goal of being transition ready should someone decide to count their own fortune instead.
So here's the why in plain language. What succession planning does for your organization. It helps reduce risk, strengthen controls, preserves knowledge, and keeps things moving when transitions do happen. One key point to keep in mind, though, is that finance roles naturally build up a lot of institutional knowledge over time. And if that knowledge isn't documented, it walks out the door when that key finance person leaves. And it's not possible to understate the importance of institutional knowledge from the finance function. Since money literally touches everything within an organization, finance staff are often one of only 2 or 3 employees that see an organization's big picture. For example, I've stepped into a director of finance role 1.5 months before fiscal year end. My predecessor had already been gone for almost 3 months. The senior accountant had been on maternity leave for about the same time, and both staff accountants were new. Don't let that happen. Don't be that organization. Have contingency plans, and that's what we're here to help with today.
Yeah, that's exactly, Tracy, when you think about people that have had longevity at most organizations, it's hard for them to document along the way because they don't anticipate, it'll be another, couple years, but that's where you really, really get caught. So
agreed. And it's easy to fall behind too during that time.
Absolutely. Absolutely. So audits can get delayed or deadlines can get missed simply because no one has the full picture of what needs to happen and when. Day-to-day operations get disrupted as people step in and try to piece things together. If reporting is delayed or inconsistent, it can also start to impact your external relationships, especially such as donors, funders, or creditors, and those are not anyone that you would want to upset. Internally, if financial reporting is delayed or less reliable, it makes it harder for leadership to make decisions. And the risk of errors or gaps in oversight goes up because those processes and controls aren't always clearly documented or shared, as we just mentioned. And lastly, technology can also suddenly stop working as intended, and no one may know why. So hopefully it's just the lack of knowing the passwords and not anything major. Oops.
So let's put some real numbers behind what we're talking about. This isn't anecdotal, it's measurable. The Bureau of Labor Statistics estimates about 124,000 job openings for accountants and auditors each year over the next decade. That's the demand side. Now compare that to the supply. There are only about 55,000 accounting degrees being awarded annually, and that number is at a 20-year low according to CPA trend lines. So right away, you can see the gap. Demand is high, the pipeline is getting smaller, and my job security is increasing. And we hear that reflected in practice as well. In October 2025, Robert Half reported that 86% of finance and accounting leaders are struggling to hire or retain staff. At the same time, unemployment in the field is extremely low, around 1 to 2%, which means most qualified professionals are already employed. And the average age of a CPA is 52 as of the AICPA's 2023 demographic survey, with 38% over 55. And that was 3 years ago.
These shortages really hit lean nonprofit teams the hardest. And we're seeing that show up in the data. A 2025 survey of nonprofits found that over a third are experiencing frequent turnover in finance roles. That's not occasional, that's ongoing disruption. At the same time, about 3/4 of nonprofits report having open positions, and more than half say they have more vacancies now than they ever did before the pandemic. So this isn't a short-term issue, it's persistent. Nonprofit accounting and grant compliance also requires specialized knowledge that can be scarce or unavailable in a nonprofit's labor market. You need to know whether that's the case and plan accordingly. There's also a broader workforce trend behind this. A large portion of the CPA workforce was already approaching retirement eligibility, which is shrinking the pool of experienced professionals. And when you bring that back to operations, the impact is real. Small teams means less ability to separate duties, which increases the likelihood of control issues, audit findings, or material weaknesses. But what we're also seeing, and this is important, is that organizations are adapting. Organizations are getting creative, leaning into technology, using automation, rethinking roles, and exploring shared or outsourced models to fill gaps. Many teams are finding ways to do things differently, and in some cases, more efficiently than before. One thing I have seen is using your board members to be part of your reviewers, for example. So while the challenges are real, organizations have been incredibly resilient in how they're responding.
Now we're going to shift into understanding your current structure, who's doing what, and where there may be gaps. A helpful way to think about this is to start by sorting finance work into 3 buckets. Ideally, these are clearly separated, although in smaller organizations, they're often blended. First, you have your day-to-day bookkeeping. This is the transactional layer, making sure everything is recorded accurately and on time. Then there's oversight and reporting. Typically your controller or CFO role. This is where financial reporting, compliance, and internal controls really live. And finally, tax and audit support. That independent review layer that helps ensure you're meeting standards and staying compliant. Where this really matters is during a transition. Things go much more smoothly when ownership is clear, who's responsible for what, when it's due, and where everything lives, even if some of that work is shared or outsourced. The biggest risk we see is when things start to fall behind before a handoff. Once you're behind, the disruption really multiplies, especially if a key person leaves. For example, that a couple of slides ago, when I mentioned my predecessor being gone for 3 months, the senior accountant on maternity leave, and new accountants, that hole can be very, very deep. So staying current, things like reconciliations, month-end close, and documentation goes a long way towards maintaining continuity and reducing risk when turnover eventually happens. And it will. And make sure your usernames and passwords are current too. You can't start anything without those these days.
But here's the reality in most lean organizations. Roles are often combined, and it's very common for one person to handle both bookkeeping and controller level responsibilities. And one thing to keep in mind, limited staff does not always mean limited risk. The risk isn't about intent or performance, it's about structure. There's a simple rule here. No one person should control approval, processing, recording, and reconciliation. That's the full life cycle of a transaction. When all that sits with one person, the organization is exposed, especially during a transition. The goal here isn't to separate people, it's to separate the functions. Even in small organizations, you can often build in separation by involving leadership, board members, as I mentioned earlier, or an external reviewer at key points. One of my previous employers, we used our receptionist to log our checks that came in the mail, which who does mail anymore? But anyway, totally outside our accounting department, but it was a definite resource to our process. That's what internal controls are, basic checks and balances. And that guidance applies even in smaller organizations. So this isn't about saying you need more staff. It's about asking, where can we add a layer of review, oversight, or shared responsibility? Cross-training for lean teams is a good way anyways, and separation of duties provides another excellent reason for it. So as we move forward, the key question becomes, where can we add the right controls? And where can we bring in additional review or support without necessarily hiring more staff? Remember, board members, receptionists, anybody outside the accounting department are always good resources.
Above are some of the must-have controls, the core checks and balances that help reduce risk, especially when roles are combined. And below is the key idea we've been building toward. You don't necessarily need more people, you just need the right people involved at the right points. That might mean your board reviewing financials, leadership approving spending, program staff tracking revenue, or an external CPA providing an extra layer of review. The goal is to spread out responsibility just enough so no one person controls the full life cycle of a transaction. Even small adjustments like this can make a big difference. Let's look at a simple example of how this can work in a lean organization.
So when considering how to separate duties, notice how the work is spread across three groups: accounting, other staff, and management. Accounting is handling the recording side, such as entering bills, processing payroll, and doing the reconciliations. Other staff can be involved in some of the key steps, such as preparing payments, opening the mail, as I just mentioned, or logging receipts so that everything isn't happening in one place. And then management plays a really important role here too. They are providing that final layer of oversight, such as approving payments, reviewing payroll, and monitoring reconciliations. And in small organizations, this can feel challenging, but there are particular practical ways to make it work. Often it's about involving the other staff in limited but important steps. We've talked about that already. For example, you might have the ED or another independent person review bank reconciliations. And you should consider having a board member approve the ED's reimbursements. Our board chair did this for me when I was in my former CEO roles. And another option many organizations use is bringing in an outside consultant to handle certain pieces. That can strengthen your controls and give you access to expertise without adding steps. The key idea is that no one person is doing it all, inputting, processing, and approving transactions. And that's what reduces risk, even in a lean team. The key in identifying the staff with capacity that you can trust with these responsibilities. So Tracy, you've been working at several of our clients. What are some examples of how you've seen these functions separated?
Some common examples are a board treasurer or another board member approving payments above a certain threshold, say $5,000 or $10,000. You mentioned a receptionist or an administrative assistant opening the mail and logging cash receipts. One example I've seen is a volunteer manager making bank deposits or a program coordinator making bank deposits. And taking custody of gift cards and petty cash, and then a director of client services reviewing the gift card and petty cash reconciliations. And I do see a question in the Q&A widget here asking about what do you mean by separate custody of assets? And I think these last two items here that I mentioned is a good example of that, is where the volunteer manager is taking custody of the gift cards and petty cash, but then you have a separate employee, the director of client services, reviewing the reconciliations of gift cards and petty cash. So you're separating the custody of assets from the reconciliation of the same assets.
Yeah, absolutely. No, these are all great ideas. And I'm sure within each organization, there's other individuals that could participate in that separation. Doesn't necessarily have to always be from the accounting department. So good stuff, good stuff.
And strengthening internal controls becomes even more important during a transition. Look at it as an opportunity. One quick reminder, transitions don't create new weaknesses. They make existing ones even more dangerous. So the work here isn't to fix things during a transition, it's to fix them before there is a transition. Think of it this way. A curve in the road might feel manageable on a clear day, but in a storm, that same curve becomes a real hazard. And my road rash proves that. In the same way, a workaround that's been working for years, especially with a longtime team member, can quickly become a compliance or control risk when someone new steps in. That's why identifying and addressing these gaps early can make a huge difference in how smooth the transition is. And before we go, I want to emphasize the IT side, like passwords and multi-factor authentication.
Absolutely.
At YPTC, we use LastPass to manage and share usernames, passwords, and multi-factor authentication. That can be a huge help during a transition. And there are many other competing software products out there to help you with that. And it's not just passwords, but also what does your financial information system support? If your organization is running Sage 50 or Microsoft Dynamics GP 2016 on a local server with manually printed checks and paper documentation, that limits options. And we'd love for you to share your other experiences in the Q&A widget.
There could be some early warning signs too that a transition may be coming, even if it hasn't been explicitly communicated just yet. What's important to recognize is that these aren't just isolated issues. They often show up as patterns over time. These aren't about diagnosing individuals. This is about reducing dependency risk. So you might start to see changes in performance, like declining quality or missed expectations, or possibly shifts in the engagement, lower initiative, less ownership, or changes in availability and responsiveness. There are also organizational risk factors, like relying too heavily on one person or having key knowledge concentrated in one role. This is where you might find out what's buried in the balance sheet. Tracy, in your work, have you ever encountered surprises?
Most recent one was an off-books prepaid expense. A little unusual, but it did save them money in the long run.
There you go. So there can also be external signals like increased networking or signs of job search activity. As you look at this list, take a quick second. What stands out to you? Are there one or two of these signs that you're really already seeing? Even if you're only seeing a couple of these, it doesn't necessarily mean someone is leaving, but it does mean it's a good time to start preparing and reducing risk before transition happens.
Now let's talk about your options. Most organizations tend to land in one of four models: a single provider, a hybrid model, fully outsourced, or some combination of volunteer or board support. And there's usually a trade-off here. Lower cost models often come with higher risk, while stronger models prioritize separation of duties, expertise, and continuity. One simple way to think about it is, what needs to happen daily and what needs an independent set of eyes? Starting with the single provider model, one person handles everything. It's simple and lower cost in the short term, but it also comes with higher risk because there's very little separation of duties and a lot of reliance on one individual. The hybrid model is most common. Day-to-day work and oversight may sit together, with audit and tax handled separately. This introduces more structure and expertise, but it still requires good coordination and can leave some gaps if roles aren't clearly defined. In an outsourced model, you're working with a team rather than one person. That gives you stronger controls, access to specialized expertise, and better scalability, but it also requires strong communication and can come at a higher upfront cost. And then, some nonprofit organizations rely on volunteers or board members to support finance. This can help from a cost perspective and add oversight, but it's often less consistent and can carry more risk, especially if responsibilities aren't clearly defined, volunteers aren't consistently available, that was me at times, or there's limited nonprofit expertise. Even with the four options above, they can be much more complex with near infinite combinations. For example, internal bookkeeping, external controller CFO, and external audit tax, or where bookkeeping and controller is combined internally, but with outsourced CFO and audit tax responsibilities. And just to reiterate, when you look across these models, lower cost approaches tend to carry more risk, while stronger models focus on separation of duties, expertise, and continuity. The goal isn't to find a perfect model, it's to understand where you are today and where you may need to strengthen things as you plan for a transition. Also, don't forget to ask whether your technology supports your financial management solution. Especially post-pandemic, technology has become even more endemic to our profession.
Yep, absolutely. So now let's shift into the practical side. Frameworks, timelines, and action steps you can start using right away. Here is where we show a 6-part action framework. This framework is a simple, practical way to think about leadership succession, from identifying risks through sustaining readiness over time. We'll walk through each step and talk about what it looks like in practice.
The first step, assessing risk, is about identifying where leadership and other transitions could create real disruption. We're looking for exposure, roles with single-person dependency, long replacement timelines, or critical work that could stall if someone leaves unexpectedly. At this stage, we're not solving the problem yet. We're simply making risk visible so we know where to focus next. One important call out here: don't forget the outgoing leader. Transitions go much more smoothly when we intentionally consider what support they may need for knowledge transfer, documentation, or clarity about their role during the transition. The risk assessment sets the foundation for every step that follows. Here are some more considerations. If there are complex federal or state grants, grant compliance and reporting may be the single point of dependency, not monthly close or regular financial reporting. And it's not just the grant reporting, but it may be applying for grants too. Depending on the local labor market, it may also take months to replace the role. and that's untenable with monthly or even quarterly reporting. There are many other examples, like who is paying payroll in the meantime? Is the technology a risk? Can you find candidates that know the accounting system? And if possible, put a dollar figure on the risk. What's actually at stake here? And finally, support the outgoing leader's timeline to enable space for documentation and transition. Are you going to keep them until 7 on their last day? Patty, how late did you work on your last day at your last job?
I was going to ask you the same question. How late had you stayed at that last day on your job? That's where you should be taken out to dinner or taken out to lunch to say, good luck to you in your next chapter, right? Not staying till 7 o'clock trying to get everything done. So yes, be respectful of that outgoing person. Good port there. So in step 2, identifying critical roles. We move from identifying risks to making focused decisions. The question here is, if a role were left vacant, which ones would truly disrupt operations, regardless of title? This step often challenges the assumption that only executive roles are critical. In many organizations, risk sits in roles tied to fundraising, financial oversight, regulatory requirements, and deep institutional knowledge. We want to also pay close attention to roles where trust and relationships matter, because those don't automatically transfer when a person leaves. The goal isn't to include every role, but to be intentional about which ones warrant active succession planning, and to revisit those decisions as your organization strategies and risk evolve. The bookkeeping role may be just as mission critical as the controller or CFO role. Vacations, illnesses, or absences can be a good stress test. Pay attention to what happens during and after those events. Call it your fire drill. What preparations were necessary for the vacation? What gaps were there during an unplanned absence? An unplanned absence from your bookkeeper can reveal a lot. Hopefully good, but definitely bad.
The third step, define success profiles, is when we intentionally pause and reset expectations. Rather than trying to replace the last person who held the role, we focus on what success in the role needs to look like going forward and how that supports the organization. We do that by defining the outcomes that matter most in the first 6 to 12 months, along with the authority, behaviors, and relationships required to deliver those results. This is also where we get disciplined about separating what's truly essential from what would simply be nice to have.
Yeah.
When success profiles are clear and transparent, it becomes much easier to evaluate talent, guide development, and explain decisions with far less confusion or subjectivity. And not everything has to happen at once. Interim replacements can lead to permanent replacements.
Yep.
So as you define success profiles, some other things you may want to keep in mind is it doesn't need to be a one-to-one replacement. Role responsibilities can be split and distributed. Focus on the must-have capabilities and consider splitting and distributing other responsibilities to different employee roles. That may also help with cross-training and separation of duties, because doesn't everyone secretly want to be a part-time accountant? So remember a few slides ago when we discussed using the whole team, not just the finance staff for internal controls? This is the time to do it. And lastly, does existing technology support the success profile? And don't forget your usernames and passwords too, or using a software package like LastPass.
The fourth step, evaluate talent. This is about taking a clear, objective look at who may be able to step into critical roles over time. We're shifting from assumptions to shared criteria, evaluating people against success profiles rather than the job descriptions. That means looking through multiple lenses, such as current performance, long-term potential, and readiness, not just who's doing well today. We also start to identify where we may have immediate coverage if needed, and where development is required to close gaps in skills, experience, or exposure. One important note here is separating these conversations from compensation or promotion decisions so we can be honest about readiness without creating pressure or false expectations. Who has the ability to cross-train and fill gaps? Can existing staff do more than they are doing now? Will new leadership change the team dynamics in a way that better supports existing staff? Use the change as an opportunity to reassess the current team and what they're capable of doing. This is one way to really show that you're hiring from the internal, like who's got that exceptional talent that you could put into that position.
With the fifth step, develop successors, is where succession planning really becomes a development strategy. Once we've identified potential candidates, the focus shifts to intentionally preparing them for future roles, not all at once and not all through formal training. Development happens through real work, stretch assignments, interim responsibilities, committee leadership, and exposure beyond someone's day-to-day job. Mentoring, coaching, or shadowing can play an important role here. But the key is that development is built into normal workloads, not treated as extra work on top of everything else. And importantly, this isn't something we only revisit during a crisis. Progress should be tracked regularly so readiness builds over time, not at the last minute. For example, in a prior assignment, I immediately identified a senior accountant as someone with the skill set and talent to manage a team. We worked together and eventually with management and HR. She was promoted to accounting manager and she eventually became my successor. That was a 2-year process. Start it now. And don't just have a plan A, have a plan B, C, and maybe D too. Look what's happened with federal funding over the last year and a half and all the chaos. There are nonprofits that went from finance departments of 5 or 6 to 1, 2, or 3, and some that went in the opposite direction. Each team member needs a succession plan.
Absolutely. So the final step, implement and monitor, is about making sure succession planning doesn't become a one-time exercise that lives on a shelf, hopefully not up there next to your strategic plan. An effective process needs clear ownership, regular review, and connection to other core processes like strategic planning and performance management. As the organization changes, roles evolve, people move on, priorities shift. The succession plan should change with that. That's how it stays current and relevant. One key consideration here is communication. When staff understand what to expect during leadership transition and what succession planning does and does not mean, it builds trust and reduces anxiety. Done well, this step ensures succession planning remains a living, trusted process rather than a reactive scramble during times of change. That's why we are so fortunate with the clients that we work on that we're able to plan out everyone's role before the directors leave. During this process, keep in mind the following: controls, responsibilities, and the tasks themselves can subtly change over time without formal documentation or after the past few years, some drastically. Succession planning is just an extension of what organizations should already be documenting. I think that was one of the things, Tracy, you and I had worked together on a client, and we had 3 months to when the director of finance was going to retire. So in that short time period, we were able to accomplish so much by getting the documentation, getting systems in place. And so that was all that whole pre-planning part of that, and knowing that this individual was already leaving. So we had that time, and kudos to the director who recognized that and, worked with us to get that done.
Yeah, and we'll be talking about that more during the case study section in just a few moments.
Yep.
And this slide focuses on what organizations should be doing now, regardless of whether a leadership transition is planned. There are 3 core areas that consistently make transitions smoother. First is documenting critical knowledge. This is the baseline and the area that catches organizations off guard most often. When key processes, calendars, and methodologies live only in someone's head, that knowledge leaves when the person does. If it isn't documented, it doesn't survive the transition. Second is using technology to reduce pain points. Transitions can be disruptive, but they're also an opportunity. If work is still heavily manual or spreadsheet driven, this is the moment to modernize so the organization is less dependent on any one individual. Don't let technology be a pain point. Third is preparing for a smooth transition through strong operational hygiene. Clear roles, secure access, and proactive communication. Silence creates confusion, and current accessible documentation makes all the difference. The more you document, automate, and prepare now, the smoother every future transition will be, planned or not.
So before we walk through this example, we wanted to ask 2 questions of all of you, and please put your answers in the Q of A. Have you personally experienced a key finance person leaving without a transition plan in place? And on a scale of 1 to 10, with 1 being least and 10 being most prepared, how prepared is your organization right now if your top finance person gave notice tomorrow? And then to wrap up what we presented here today, we will close by going through a case study next. Tracy, take it away.
Thank you, Patty.
Oops, we went too far.
So let's walk through a real life case study. In this example, a mid-sized nonprofit relies heavily on one finance manager for grant compliance and reporting, audit and single audit preparation, and monthly close and board reporting, with a bookkeeper handling daily transactions. That finance manager plans to retire within 9 months, but there's no backup or documentation for those higher level responsibilities. So let's apply the 6-step framework from a few slides ago. Though before we do that, please note that many of these steps happen concurrently, not in discrete steps separate from each other. With that said, where do we start, Patty?
Well, let's start with how the organization assesses its risk.
So first, it identified dependency risks for several core responsibilities like federal grant compliance and reporting, audit and single audit preparation, and monthly close and board reporting. Out of those core responsibilities, the organization identified federal grant compliance and reporting as the biggest risk due to the lack of relevant experience in the local labor market. The organization also identified its accounting information system technology as another significant risk. It was using Sage 50, formerly Peachtree, hosted on a local server, and the organization's workflows and document retention were both paper-based. Those limited options. And with no additional capacity in the finance team, it was currently impossible for them to upgrade anything.
Wow. So how did the organization identify those risks?
So it reviewed its current processes and documentation of those processes, or lack thereof in many cases, the strengths and weaknesses of its current team, and then clearly identified the roles of the existing staff.
Wow. So that's an excellent lead into the next step in the 6-step framework. How did the organization identify critical roles?
As we just kind of foreshadowed, the federal grant compliance and reporting is the critical role. Not only does it impact finances, but it impacts the organization's ability to fulfill its mission. You can't do anything without the grant money, the monthly grant reimbursements.
Right.
And leadership of the other finance staff was the other critical role. There were some existing personality conflicts, and the hope was that new leadership may change the dynamic.
So were there any tricks to this step?
Nothing tricky. It's just standard due diligence. Talk to peer organizations about the local labor market, keep an eye on job listings, And of course, pay attention to your team and how they work together. These are all things that you are hopefully already doing.
Okay, but how did the organization define success?
So it ultimately decided to outsource the finance manager position due to the difficulty in replacing grant compliance and reporting experience. That was the must-have capability.
Yeah.
Also, during the transition period, the successor developed and implemented new processes and technology. However, the successor was not a one-to-one replacement. Due to the limitations of a remote outsourced controller or CFO, plus the additional costs, it was necessary to shift around some responsibilities to other staff, which included some non-finance staff.
Yep, there's those receptionists and board members. So, okay, that's what happened, but how did the organization know whether it was successful?
So procedures changed dramatically. I mean, not only was the organization moving to a new financial management model, but it was also moving from manual physical workflows to electronic ones in a brand new accounting information system. So those changes actually helped to define what success would look like. If the organization could follow the new processes without significant or any negative impact to its mission, then that's success. So that brings whole new meaning to the phrase process driven. That's literally your success profile.
Yeah, absolutely. So what were the process to evaluate talent and then develop successors?
In small to medium organizations like this one, there may not be enough staff for these two steps to work in the traditional sense. And that's why we're kind of combining them into one discussion point here.
So then what did they do?
Well, we mentioned several times that it may be necessary to involve non-financial staff. Sound familiar? So if there aren't enough accounting and finance staff to make these steps viable, look outside that team to evaluate talent and involve them in the system of internal controls and as backups. Also, in this organization's case, the transition substantially changed the team dynamic. The existing finance staff developed and took on additional responsibilities. While that's not a successor per se, the additional responsibilities were assumed from the previous finance manager.
And so that brings us to the final step in the framework, which is to implement and monitor the transition plan. So what's the key takeaways from this final step?
It's that you start with the first step and continue through everything again.
Just a cycle, keep going.
It's a feedback loop. When we started this case study review, we mentioned that these steps happen concurrently because it's an ongoing process. And that served this very organization well when the finance associate retired 2.5 years later. The role matrices, process documentation, finance calendar, and risk assessment were never stopped during those 2.5 years. In the meantime, there was even a month-long family emergency that stress tested the entire system. Don't worry, everyone was okay. But
yeah, that's good.
It helped inform the next transition.
Yeah. Well, and it's really interesting with such an example like that is you're planning along, you know, for these emergencies, and then all of a sudden an emergency happens. So now you're like right in the thick of things and start documenting again, you know, so you just never know when those situations can happen. So document, that's all we can talk about, you know.
Absolutely. And that month-long family emergency, it revealed some issues. So we had to go back to the drawing board and adjust afterwards. You know, it's these types of things you need to pay attention when there's something weird that happens, because it can give you more information on what you need to change moving forward.
Yeah, absolutely. Oops, I keep hitting the button. Sorry about that. Tracy, it's all yours.
So that concludes the 6-step framework. And we wanted to leave you with a practical example that you can incorporate into your own work. And this is what succession planning looks like in practice. It's not about doing everything at once. It's about taking a few focused steps to reduce risk. So you start with documenting key processes or assigning a clear backup and build from there. And while this example is based on our case study, the overall structure, breaking things down by focus area, action step, and ownership is a simple, effective approach you can apply in your own organization. And this is just another way to look at what happens during the 6-step framework.
So in closing, let's look at some key takeaways. First, assess your structure. Who owns what functions? Look for hidden vulnerabilities, which is actually risk, and take this opportunity to strengthen your internal controls. Second, consider what your future state looks like. Will it be internal, outsourced, or a hybrid approach that supports both day-to-day activities and independent reviews? And look for opportunities to separate duties. We talked a lot about that, the duties, the oversight, and the continuity. And lastly, plan for a smooth transition. Document, 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 I can't say that enough, and implement controls and reduce risk now. Just want to mention, in going through the chat, those of you that responded on our survey of the 1 to 10, there's a lot of you that were below the 5. So you are in the right place by watching this video. And I hope that there's something here that you can take away and implement so that you can move those 1s and 2s and 3s up to a 7, 8, 9, and 10. So lastly, we'd like to thank you for joining us today. We are so grateful for your time and engagement. So please complete the evaluation survey and let us know your feedback and any other training topics you'd like us to cover. For those of you who need to go, we look forward to hearing from you in the future webinars, and those that can stay with us, we will be taking the next 15 minutes or so to answer any remaining questions we received today. So thank you all for joining us. We appreciate your participation with us. Seeing any questions?
So here's a question about planning for terminating a finance director or controller.
Yeah, I saw that. That's.
So I think in a lot of respects, it's not different from any other transition, except for obviously some of the HR issues that you may need to dance around, but it probably makes documentation even more important. What do you think, Patty?
Yeah, that was, and hopefully there was some documentation, but it's also an opportunity to kind of look at, what is the reason for the termination? And does that apply to the work setting itself? Were there things being missed? So that you can make it a really, really high point to document that as being important to this particular role. But I would go back and to look at the reasons for the termination and go from there. And hopefully you've got an updated job description so that you can break that down and really identify the task of that position and what needs to be done. And look to outside, look to other departments. What were they missing? What do they need? Where were some of those deficiencies? Good question. Very good question. I see one question about what accounting systems do you recommend? I know the majority of the nonprofits that we work with, QuickBooks Online is the most common. And we do know that there are some that are still using the desktop version, and that can be a little cumbersome because I know that the support for desktop has ended already. So that would be the one reason to move to the online version. But also I know the online version integrates with many other software packages, such as your donors and any other kind of specialty software that you might need. I think QuickBooks is pretty high on the list with integrating with a number of other softwares.
Yeah, bill pay software, expense management. I mean,
yeah, especially your electronic.
But that's something that can also be very personal to your organization, its size, its requirements. So, but QuickBooks is, a good one size fits all type of approach. Here's a question about, how much does a financial leadership transition, recommendations we've given today translate to an executive director, particularly one where the executive director is heavily involved in finances?
That's a very interesting concept, because in my last role as the CEO of a nonprofit organization, I had a finance director that had been with the organization for many, many years. And I, with everything that she knew in the finance role and every aspect that she saw from that finance director role, both in programs and development, my biggest recommendation for the next CEO was her. And I know it took a little challenge, and it took another person stepping in, but they had left. And so now she has stepped into the CEO role, and she has become very successful in that role because she's learned so much. To me, the finance piece is like that, the central of that spider web in any organization, because they see everything flows through the finance department. So I am just so proud of her of stepping into that CEO role, because she had the chops and she certainly had the finance, because that's a big piece of being in that CEO role, is knowing the finances or not knowing the finances. That can be quite risky. So that's a natural progression. Good for her.
And with that executive director transition, is that institutional knowledge of it is something you need to preserve. So
yes,
having that transition period where that institutional knowledge can flow from, the outgoing executive director to the incoming one would be ideal. Of course, that's not possible in every organization. That is a little bit of a luxury, but you need to take that as a model and make sure that that institutional knowledge is documented somewhere, somehow.
Yeah.
Here's a question about what if the organization is just two people and the board isn't very finance savvy? I would think, go ahead, Patty.
No, I was going to say, even though they may not be board savvy or finance savvy, you can train them how to review a reconciliation, what to look for. Look for some of the simplest things and go from there, or switch back and forth between the two people that you do have. We talked about that full cycle, maybe switch back and forth between the two people doing like the inputting versus the reconciling, and then the requiring the approvals and things like that. That's where you could go to the board, is approvals, especially with some of your CEO transactions. That is where I always felt board members were very, very useful in helping step into some of these reviewing roles, not necessarily the doing roles. Good question.
Yeah, just want to reiterate what Patty said about education is, your board has a fiduciary duty. So they have a legal responsibility to understand the organization's finances. So that's something you can discuss with them, or, and help educate them about what matters to the organization financially.
Yeah, absolutely. I'm seeing another thing in the chat where they had a bookkeeper leave without notice. Oh, that's brutal. That's immediately where whoever's been reconciling her work might want to get in there and start taking a look at that, or look at the transactions. And in many of your softwares, you have an audit trail to see why there was a leave without notice, just to make sure you're covered risk-wise. But hopefully there is some kind of documentation for that person. That's like the worst. Let's see, what else?
Here's one about just a separation of duties question. And this is a pretty good example, I think. The question is there a major issue of having HR staff process payroll, but the controller review it, plus additional business administration staff also involved? So the example is the vice president approve it after HR prepares it, plus the grants manager doing a final review. These are all great examples of having multiple departments involved in a review of a single process, and a good example of separation of duties where you're having HR prepare and process payroll, finance review payroll, and then having a grants manager involved in the final review as well. And that's especially important when there's lots of payroll allocations to grants.
Yeah. When I'm seeing that there's a lot of questions about applying or getting outside people from outside the finance staff, I think we talked a lot about your receptionist, even some people in your programs that they come over and just look at your, kind of scan your deposits or record the checks. I think a lot of people have talked about using their board members for reviewing. I know in one organization I was with, we always had our executive director, even though we had an internal finance person do the bank reconciliations, we always gave those reconciliations after they were reconciled to the executive director so that she could just kind of scan the transactions to make sure that they were all things that she had signed at the time. So even beyond the accounting staff, look to board members, program staff, anybody that's really interested in learning more about how the financial aspects roll. So good stuff. I just saw, this was kind of funny. I saw someone in the chat say 7 o'clock sounds early. I feel bad for them.
Yeah.
Wow. That was funny. What else do we have here? Oh, I love this. Someone's mentioning how they were going to be retiring in the next 3 to 4 years and have cultivated a controller's guidebook to fully document the core aspects of their role. Explain that. Good for you. That's exactly it. And they have decades of institutional knowledge, and that cannot easily be absorbed by a successor. So good for this person, Kevin, for putting that all into documentation. That's the way to do it.
Circling back to that comment about 7 o'clock sounding early, here's a question about if staff is already stretched to the max, how does the board manage for expansion of roles? And you could say is creating the time and space to make transitions possible or to upgrade the accounting system. That's an instance where the board needs to get their hands on, their hands a little dirty and jump in and help out. That's really hard in a lot of nonprofit organizations where, you're either heavily relying on existing staff that are already overworked or volunteers, and you just have to leverage every resource you have available to you, whether that's your board or other volunteers to help you create the space for transitions to successfully happen.
Yeah. Some of the questions too are about using this process outside of the finance. I think that's what that question was before. You could apply this to any position in your organization, the executive director, your directors, development, really any of your positions, to have some kind of a succession plan for basically every role in the organization, from top to bottom, because all of your individuals that are working in any of these departments have key roles, key spots. One kind of depends on the other. So if that one person leaves, you've got a gap. And so, truthfully, beyond the finance department, this same process can apply to anything outside of the finance department. So yes, good question. That
6-step framework is not specific to finances at all. It can be adapted to anything.
Absolutely. I see another question about having an HR staff process payroll, but controller review. One of the biggest internal risks we've always seen with when you have a full-blown HR department versus a finance or accounting department, the biggest thing you do want to separate is that HR staff person that actually recruits people and enters people into your payroll system with their names, their checking account information, and how much they're being paid and all that, to also be processing payroll. That's a huge risk, because now they can do that setup of what we call fictitious people and start paying their own selves. So that is one place that I would definitely separate, or at least have, if your controller review is looking for names and ensuring that these are all staff people's names, not fictitious names. Mm-hmm. That's the biggest risk. And I know in a lot of organizations, the HR person is also the same person processing payroll. So if there's any kind of separation you can do there, go for it. But if not, have either a higher level individual just scan the payroll report for the names that are listed on that particular payroll report. Good question. What else we got here? All great questions. Wow. People are really thinking this through. Mm-hmm.
It's a pretty universal experience, just judging from my own career.
Yeah, yeah. Oh, someone asked about what the name of the password platform. That was LastPass, L-A-S-T, pass.
And there are tons of other examples out there. Google has one, plenty of them available, but something you absolutely can be a huge boon during a transition.
Mm.
Let's see.
I want to just think again, all those people that put in the Q&A there, 1 to 10. And then there's some that were prepared, so that's great. That's what it's all about, is documenting.
Here's someone who gave 2 years notice for retirement, and I just say kudos to you. You are a saint for doing that.
Yeah, absolutely. It also gives you an opportunity to see if there's anybody in-house that might be interested in learning that role, where they, I've had people come from our program departments that are interested in just learning about finance and kind of doing a rotation with every department. And maybe that's a good opportunity to do cross-training. I know we had some of our development staff do our reconciliations between the finance and the development software programs. And so she got to learn a great deal about finance. So even if no one's leaving or anything like that, you can still do cross-training across departments, just to, they may be interested in something beyond what they're already in. So it's a great morale booster, truthfully. All good questions. Oh, then here's one where they had their AP person was in a car accident. And it was at that point that they started planning and cross-training, and it kept current over the years. And that's unfortunate that it had to take an emergency situation, but luckily they were able to recoup from that and start identifying and documenting everything. So don't wait for that emergency to happen. Start now. But good for them.
So here's a question, and I think this can be answered in a pretty general fashion, which is, how do you document all the things the executive director does? You could insert finance director or whatever,
Any
leadership
role.
role in an organization. And the way that I personally like to do it is, of course, an accountant's going to say use Excel, but to create kind of a matrix in Excel, listing each of the responsibilities in one column, and then in subsequent columns who that responsibility is going to transition to.
Yeah.
And it just creates a really clear, 1-page wide look at, here's all the responsibilities and here's going to be taking over for them. So that's something that I like to use for a lot of roles, is that kind of responsibility matrix.
Yeah, and some of the things that I've done is start with the job description. Take that job description and separate it into categories of, doing, reviewing, outreach, just whatever that might be. And then go from there on, and that's a good point of identifying who could take that on, especially in an interim role. Like who could, from all of your staff, do that particular function. And then that becomes a great platform for the person coming in once they do hire a new CEO, that now they've got all those separate job duties. They've got a person that can start, doing it in an interim role. And then what are those specific functions? Now, I know those job descriptions are very high level, but boy, it does trigger your mind as to all all those little tasks that make up that one function. You can start breaking it down, but it's at least a good starting point. So I love that idea.
Here's a question. How do you convince board members who seem disengaged from finance matters that we need succession planning for a 30-year controller/bookkeeper?
Oh, geez.
Yeah.
That's a good question.
So I think it's the documentation. Once you get that 30-page policies and procedures manual together, or however long it may be, and you present that to the board and ask them to approve it and say, we need to plan for who's going to do this next. You have to give them something concrete showing how important it is to have a plan here.
I would also create a list of all the things that they're getting from the finance department and as a board member to help them make decisions, mostly being those financial reports. Think about what life would be like without those monthly financial reports or any indication of where they stand financially, because not knowing as a board member where they stand financially is a huge risk. And so I would stress what the finance person is producing, all those analysis they're doing, all those grants they're writing or overseeing and reporting to, and documenting that money as it comes in the door, or if it's late. I would stress all of what will become your deficiencies, your outstanding AR balance, your outstanding AP balance. And for those of you who don't know, AR is accounts receivable and accounts payable. Once those little balances start incrementing, you've got issues. So that's a very important piece that the finance person manages, or at least oversees. So start thinking about what's going to be lacking once that person departs.
And I think there's just time for one more, and this is, I think, a pretty important one. How do you help the finance person not feel threatened by succession planning? I think most people who work for nonprofits, or especially in that role, are pretty dedicated. They're there for a reason. It's not necessarily compensation. So you need to appeal to their loyalty to the organization is one way of doing it. And also just, we have our win the lottery rule. If I win the lottery, and I win $20 million, sorry, Patty,
Yeah. No, you're not. Well, the other situation, and we've had this happen a number of times, is you've got a person in a very high level, like a CFO or whatever, they're in a car accident and they can't speak. Now you've got passwords to deal with. Now you've got, I wouldn't want that. As I'm sitting in that hospital bed, do I really want to be worrying about what's going on in my office? Yes, deep down, yes. But for the good of the organization, it's just anybody can step in if something should happen to that person. But I would say, if anything, it's for that emergency situation. Or the good thing is winning the lottery is, that would make me feel good to know that there is something behind me that someone can just step in. I mean, and that's how we work here at YPTC, and that is we are always transition ready, that if anything should happen, and we look at it more of in an emergency situation, that someone can immediately step in and continue things on. Because guess what? Payroll's the next day, and who's going to do that? And it's probably good as you're doing that is who's your backup plan? Who can do that? Who is trained? All of those responsibilities, who has the ability to actually perform that function? But that's a good question. Well, I think we did a pretty good job of answering a lot of these questions. We had some good time here. And also just everybody, the recording is going to be sent out to all of those that were registered today.
Yep.
Yeah, the
Thank you
recording
so much for your
and
time.
slides.
It was a pleasure here today.
Yes, and Tracy, good to work with you again, or continue working with you.
Thank you,
Same
Patty.
time
You
next
too.
year, okay?
To be determined.
Right. All right. Bye-bye. Now you get